Hello, and welcome to Arnerich Massena's third quarter 2019 MarketCast. Following a strong first half of the year, stocks stalled in the third quarter on mixed economic data and uncertainty related to the US-China trade war. With markets turning choppier, we're seeing some interesting dislocations and potential investment opportunities, which research analyst Ben Larsen and senior wealth advisor Glen Goland will share with you today. Thank you for joining us.
Thank you, Brian. In the third quarter, investors' expectations for volatility crept higher, setting the stage for lower risk investments to outperform. Perceived safe havens such as the US dollar and US bonds led the way during the quarter, with most other US investments also earning small positive returns. However, non-dollar investments such as international and emerging market equities gave back some of their previous gains as the US dollar climbed. And despite the mixed results, all asset classes have earned positive returns year to date. Looking more closely at performance difference between the US and international equities, we can see that US stocks have been leading international stocks since 2011. And historically, periods when the US led the market have typically coincided with periods of US dollar appreciation, while international markets have generally fared better when the US dollar is declining. While no one knows when the current cycle of the US market leadership will come to an end, it's worth noting that the US dollar is currently ranked as the third most expensive major currency behind the Swiss franc and the New Zealand dollar. One reason for the US dollar's appreciation in recent years has been that a growing number of European and Japanese bonds have been trading at negative yields, while US bonds have continued to earn positive yields. And while low or negative yields can stimulate economic growth by encouraging private investment and consumption, they can also cause instability in encouraging excess leverage and risk-taking. One place where the level of risk-taking has become worrisome has been among unicorns, which are private startup companies valued at over $1 billion. These companies are notable for their large projected growth numbers and addressable markets. Despite their appeal among venture capitalists, several unicorns have not been well received this year by public market investors due to their capital inefficiency and lack of earnings. For example, Uber and Lyft declined by more than 30% after going public, and WeWork postponed its initial public offering after its valuation declined by more than 75%. This year, a whopping 92% of companies were unprofitable at the time of their initial public offering. So then, where are the investment opportunities? While developed economies have been financing growth through extremely low interest rates, emerging and frontier markets continue to experience a high level of organic growth. The potential long-term opportunity is vast. 45% of the world's publicly listed companies are in emerging and frontier markets, and by 2050, 89% of the world's population is expected to be living in emerging and frontier countries. Emerging economies currently account for 59% of the world's GDP and are projected to grow 3.3% faster than developed economies. With market volatility back in the news, it's a good reminder that staying invested long-term can result in better investment returns, because trying to time the market twice, both buying and selling, is extremely difficult. For example, an investor who missed the 10 best days in the past 20 years would have reduced returns from 5.6% to 2% annualized. Since January 4th, 1999, 6 of the best 10 days occurred within 2 weeks of the 10 worst days, while the best day of 2015, which was August 26th, was only 2 days after the worst day, August 24th. During periods of market decline, selling securities to seek safety in cash can be counterproductive because the worst days are often followed by the best days. And now, to look at our views on portfolio positioning, I'd like to introduce Senior Wealth Advisor Glen Goland.
Thanks, Ben. With U.S. stocks hovering just below their all-time highs, we're continuing to look at opportunities to rebalance and diversify portfolios to include attractive undervalued investments. In particular, we're tilting towards international equities, which include emerging markets, and we're favoring value stocks, which are inexpensive relative to growth stocks. Among bonds, we're favoring low-duration bonds due to the shape of the yield curve, and we're continuing to limit our exposure to lower quality credit. Where we do invest in credit, we prefer skilled active managers who can individually weigh each credit opportunity. As always, your advisor will keep you informed about specific investment opportunities as they become available. We are excited about our upcoming Impact Investment Lunchtime Forum on November 13th at the Multnomah Athletic Club. We'll be hosting a panel of experts and managers in the impact investment space who will discuss their strategies and field your questions. Look for more information coming soon. We hope to see you there. Thank you for joining us today.